Finding and attracting good deals, guys. This is super important. This should be our number one thing we're focused on. And then the other thing is finding and attracting capital. If you master those two skills, you are dangerous, right? You know how to find good deals. You know how to attract capital. No matter what industry you're in, you're going to do well, right? Finding and attracting capital, it can go anywhere, right? We're not wasting our time on bad deals. This is what kills investors the most. All right, we've taught thousands of people so far, and I tell you what, this is probably the biggest killer right here, is spending too much time on bad deals. All right, so now, cool thing about this week, we're going to try and pump out as many LOIs as possible. But the thing about this week is you're probably not going to send a bad LOI, or you have too many people in the room. Jack being the primary suspect here, you got too many people in the room to submit a bad LOI. So if LOIs do go through, then you can probably feel pretty confident in those LOIs. But either way, we want to create a focus on maximizing good deals and spending less time on bad deals, poor management of time. And then the last thing is just being inconsistent. So for this, we've got to get up to making 3 to 5 offers per week. And the most important one is finding and attracting good deals. Because at the end of the day, as we go through the equity splits, you're going to see, the person who finds the deal, at the end of the day, they have control, right? They're the ones that they found the deal. Now, they're going to need different things in the deal. So then that's a negotiation. That's a discussion that we have to talk about, is like, who's going to play what parts based off the risk, based off the deal, based off different things. So we're going to break that down to a T. All right, so today we're going to cover buying criteria, core marketing channels, your napkin analysis, pulling your list, and scripting and calling. Again, what we want to do in this event is just hyper-focus you on how do we get the most deals in the room, right? We want to have just a groundbreaking event where there's so many deals that it's inspiring, but it's also we're all participating together. Look, I wanted to share this guy. You've probably seen him before. Josh bought 200 units in 9 months. They're what we're talking about today, okay? Now, Josh had a full-time effort. That wasn't just 5 hours a week, right? This was a guy probably in your situation where he's spending 4 days. He had a lot of time, 60+ hours a week, right? Now, buying 200 units, that was broken up over a couple different deals, or a few different deals. Now, again, you just break that down. What kind of time capacity do you have, right? Because at the end of the day, we got to be doing good deals. And what that looks like is being consistent in the time that you have, okay? This guy, Glenn, a good friend of ours, bought over 72 units in less than 12 months doing the exact same things we're talking about at zero experience, all right? So step 1, write this down, buying criteria. We are about to dive into your buy box and your core marketing channels. We just updated our buy box. And so we have a strong, we have a deeper scope. Am I here? Yeah. We've detailed it more, and so I'm about to share that with you. But key thing about your buy box. All right, so some of you already have your buy box nailed down. Some of you are just looking at everything out there. Some of you are just entertaining anything that comes over your desk. And it's very tempting to do as a new investor, because you're just like, I just want anything. Right? And that could be a temptation. But I promise you, if you can nail down your buy box to an exact figure, which I'm about to go through, and get it refined, think about this. When a broker comes across a certain deal and you're just doing any deal, who's he going to think of first? Probably not you, because you're just one of thousands of people he's already talked to that may be open to that deal. But if you called that deal specifically, if you said, I'm looking for 20 to 50 units, or if I'm looking for, and it's got to be a light value add or medium value add, and you're calling out that exact thing that he's looking at right now in that area, right? It's going to be much more chance that he's thinking of you, right? And that's just from a standpoint of we're creating our brand, right? This is what you're trying to do. Because every single time, I'm going to go through, I think on day 4, and show you how different people have scaled And typically, right after their first deal, guess what? They're getting calls left and right about all kind of good deals from other people. And it's just a snowball effect because you just put all this work in on the front end. Whenever you've created, whenever you've gotten that first deal, you put in all this work to build your brand and have people know that this is what you're looking for. You've connected with tons of people, you've talked to tons of sellers, and so that brand is what now then snowballs. And you begin to do 2, 3, 4 deals in the same amount of time that you did that one deal. All right, and so I'm going to show you a bunch of case studies how people did that and partnered up to do that. But it starts with narrowing down your buy box. All right, so 20 plus units. If you are just starting out, go lower. But I would still say 10 plus units, right? I mean, even 20 plus units is pretty low, but I would say bare minimum 10 plus units. I mean, we did a 16 unit deal that was in our backyard, right? So even for us, it's not that big of a deal if it's right back behind your house, right? If it's right here. Or if you have a team in place that's already running deals in that area. Right? If you have a team in different markets, then obviously you can go lower in those markets. And so that's what we're about to share with you about our buy box. Because now that we have teams and boots on the ground in different places, we can now expand. Right? That's the idea. So we're typically, and I'll break it down in just a second. Georgia, Florida, Alabama, North, South Carolina. We're expanding into the Sun Belt. And we'll talk. And then we can even do things. We've done things in New Hampshire. We've done things all over. But it's really just about the boots on the ground. The people that are in that area. Do we have solid boots on the ground people that are able to help us with the deal? And then value add, light to moderate value add. You've heard me talk about this all the time, right? So light to moderate. We're not doing heavy renovations, heavy new construction. And if you want to do that, you got to talk to Arthur. I'm just kidding. So, I mean, look, we're not going to say don't do a deal that's heavy repositioning or heavy value add, as in full guts. It's under 60% occupied. We're not going to say don't do it. We're just going to say typically it's not the best to focus on. All right, as a newer investor. It's like I get people to ask me, I want to do new construction. It's like, well, have you done it before? No. Have you had any experience in new construction? No. It's probably not going to work, right? Or it could work, but you're taking on more risk than you probably should, right? As a newer investor. Now, if you have experience in new construction, you have experience working with that kind of deal, and not only that, you have the liquidity, right? You have some reserves to hedge for that risk, right? It may be in the question, right? But it's based on your situation, right? If you are wanting to do heavy repositioning, that just means that you have to be willing to wait longer in what's called lag time, right? So from the time the shovel hits the dirt to the time it's built and it's bringing in income, it's called lag time, right? That means that you're vulnerable all through that. If the market crashes, whatever happens, then all of a sudden, this is what happened, recently in recent years. They couldn't finish the projects, and so they couldn't make sense of it. So it's just going to increase risk if you're doing heavier, guts and renovations. So AB areas, BC properties, all in at 70-80% of state values value. Just, we've already talked about it. You're not looking for Class D areas. If you're in Class D areas, it's not going to appreciate. It's going to be hard to keep up with. And then guess what? You're going to do one deal. You'll be like, I don't want to do any other deals. Right? Or I need a year before I do the next deal, right? And you're going to be managing that property. It's going to consume your life. And then that's not conducive to actually growing and scaling.
What classifies as a Class D area? What are you looking at? Like bad schools, gangs?
Yeah.
What?
Yeah, so I mean, Class D just means it's like war zone. Yeah, gangs, okay. Crime is really high. You would not want to live there, right? Yeah, if you don't want to live there, I mean, you
don't
say,
buy there.
I would buy there. Yeah.
Okay.
78% of stabilized value. So we're going to talk more about that in the adaptive analysis. But let me zoom out here and show you guys our buy box here. So this is our buy box when it comes to REI capital. And deals that do not meet this buy box should not proceed to partnership or underwriting discussion. Okay, so this is first step. That's what I say. Biggest issue is people spend too much time on bad deals. So that's the first line right there is don't, if it doesn't fit this, it's a no-go, right? We don't keep going. We don't just entertain it for the sake of maybe I could step out of my buy box and try and make it work, right? It's not going to help you in the long run. If we're thinking about efficiency of time, you've got to stay focused, all right? So market location, minimum 25,000 population, preferred 50,000 plus for stronger stability and liquidity. Market fundamentals, stable or growing population, solid employment base, and income trends, all right? Regulatory environment, no rent control, reasonable eviction timelines, city specific, acceptable. Again, if you have questions about any of this, just save it. We're gonna bring a Q&A in just a minute, okay? Neighborhood quality, C+, B- or better. All right, avoid high crime or declining submarkets.
Well, just to say, a lot of times people say C class, but there's such thing as C minus that can be very difficult. But it really goes to that area, high crime, declining markets. But nothing really to add there. Yeah, 25,000 population is not a hard, probably firm, but we bought deals in 10,000 area populations, and I've seen a lot of deals brought to the group. But they can work short term, but what we've experienced is just being able to exit those, sell and refinance. Cap rates are higher, tenant demand is lower, so there's a lot of reasons there.
Yeah, and that's the one place it's like, okay, C-, C+, you got to kind of do your homework there. So that's the only place I'd say you may not necessarily know off the bat what that area is. But yeah, I mean, C-, it may sound nice. You may have a killer deal. And I'd be willing to look at the deal, but it's definitely can bite you, right? Better to do no deal than a bad deal.
Yeah, you normally can determine it in about 30 seconds on Google too.
C- versus C+?
Yeah, I mean, people have the C- deals. I say, yeah, but this and but that, but they're still shooting each other in the parking lot.
Yeah. Asset criteria. Property class, C+ or better. Area class, C+, B or better. Vintage, 1980s or newer. 1980, pre-1980 or, I can't talk. A considered if located in B quality areas. Deferred maintenance, so that means, typically in B areas, things being renovated, that years improving. What's that?
Only about all the areas.
Yeah.
Felt the mic surge coming.
So unit count is 75 to 250. Now there's a caveat there. And the reason for that is it supports on-site management and operational efficiency. Okay, less than 75 units considered in markets where we already have a strong presence. Okay, so from our buy box perspective, this is what we're looking at. Occupancy 85 to 95% plus, preferred. Minimum 75%. Okay, 50 to 75% considered only if offset by strong market fundamentals, clear operational upside, conservative underwriting, and then CapEx budget less than or equal to 25% of purchase price. Again, we're steering away from large, heavy renos. Basis, we must be less than 80% of stabilized value for CB class. Okay, 80 to 90% for B plus and A class with strong in-place cash flow. All right, deal structure and returns. Target IRR of 17 to 22% for our limited partners. Cash on cash, strong likelihood of 6 to 8% plus post stabilization. And then business plan clear, executable, value add strategy, realistic rent premiums and timelines. So any deal outside of this buy box requires explicit approval from REI Capital leadership prior to everything else. All right, everybody clear on that?
Quick question.
Go ahead.
What's the typical holding period? For the buy box. 3 years, holding year,
3 to 7.
5 years.
3 to 7.
3 to 7.
Bigger rates, but it depends on the deal, right?
Got it, yeah. Does that impact your equity multiple in IRR? So that's what I understand.
Yeah. Really, three to grandchildren, really.
Yeah.
I mean, if it's a deal really like at one time it's Bob's, I don't want to have any intent of selling it.
Like that.
Ever.
All right. So here's a buying criteria form. We have this is going to be sent to you in your email. So that's going to be one of the big things. Okay. So just grab the form, start filling your buy box out after looking at our buy box. And in that document we're sending you, it has our buy box that just went over. And then it has a form that you can fill out like this. Okay. So make sure step one, and we can move on to finding deals. It's nailing down your buy box. All right. Now we're going to talk about choose your channel. So you can pick any streams you like, but this week we are going to talk about the 2 streams of deal flow that I believe is going to move the lever the most, move the needle the most for this event. Okay. And that's going to be direct to seller and pocket listings from brokers. Direct to seller, pocket listings from brokers. The pocket listing still technically means, in my opinion, it's off market. I mean, you could say, well, it's still marketed to his email list of 1,000 people, but it's not on that and Crexy. Okay, it's not on market being publicly advertised. That's what I consider off market. Okay, so direct to seller and brokers. Okay, so our primary channels, here they are. Pulling lists off market properties for calling and mailing, finding brokers, key players, calling and texting. So that would be the third one. If you're going to tap into anything else, is power players, right? People that you may know in your network, or you may just want to connect with, state attorneys, any kind of attorneys, pretty much, that are talking to sellers and brokers. I mean, there's all kind of power players that you can reach out to. So that's going to be another one. Larry, walk us through this deal. This is one I just filmed at last week. And if you guys want to go by there, you can. If we had a smaller group, we'd probably host it at this property. But it's an 88 unit deal, and it's in Phoenix City. So if anybody wants to go by, you can. Maybe we'll take a group or something later this week.
Yeah.
Go ahead, break it down.
851 25th Avenue is the address, Phoenix City, which is just across the river. This was a LIHTC property, which stands for low income housing tax credit. If you're not familiar with that, it's just where the developer gets really nice fees and tax incentives to build a deal. They're very competitive. There's an application process, and there's only so many to go around in the state. So we would rather buy them at the end of their LIHTC compliance period. There's deed restriction that goes with these for anywhere from 15, 30 years. And the restriction is they have to rent to low income residents, and the rents are capped based on those rent amounts of median income or low income limits. So this was built in 2008. So the end of its compliance period is actually the end of this year. So we can take it. What that means is you can apply to take it out of the program and then take it to market rate rents and IR restrictions. And there's no reason we wouldn't do that, because we're not getting any advantages of it being a tax credit property at this point.
You get that when you build.
Yeah, there's no, and the developer, we bought it at a really nice price because they're actually a nonprofit, and they got all their fees, and they were running it not profitably because they don't really have any incentive to run it profitably. Is that a word?
Yeah, it's
Profitably?
That's a great word.
Sounds good. Anyway, I'm an engineer. I can make up words. So it was off market broker that we had a good relationship with us, brought it to me. Actually, maybe his favorite buyer had backed out. I don't know. I thought it was his favorite, but they had fallen out of contract because another deal they had didn't sell, didn't go through. So we were able to jump in and give him the price they wanted, which is a really good price. It was about $45,000 per door for a 2008 built property. Without knowing anything else, you would think that's a good deal. So $4 million purchase price. The occupancy was 96%, just not being run efficiently and not not increasing the rents to where they could. So, the calculation we did during underwriting was we could be charging $760 per month, and they were getting like 600 or 770. It was $160 off. And we had 225 improvements budgeted. The property was in really good shape, just minor items and a little bit of buffer for the unknown. And then we had to put up reserves of $213,000. We used a local bank, and they required us to put up 6 months of principal and interest payments. So it was just a local bank, short-term loan, 5-year loan, with 18 months interest only. So the acquisition cost $142,000, and that included our acquisition fee that we took, and that gave a total cost of $4.58. So the loan was $3.38. We had to raise $1.2 million to give us that $4.58 million required. So that was all from investors, not any of our own money. We certainly don't have an objection to putting money in. I like putting money in loan deals, but we actually had more investors that wanted to put in money in this deal than could. We had to tell a few of them to, catch the next one. So based on the pro forma, raising those rents $160 per month, and if you've watched Jonathan's training, he goes through that exercise of how multifamily properties are based on the net operating income. So every you raise the rent, $50 per unit on a 100-unit deal, and you increase the value of $1 million on the property depending on the cap rate. So we're able to raise it $160 and reduce expenses or run the property more efficiently. So with that, it goes from being worth $4 million to $6 million, which it is today. And then this 5 to 7 year projection is based on taking it to market rate rent. So instead of $760, which is really about $800 today, we'll be at $950, $1,000 a month rent. So that's another $200. So that's where that additional $2 million would be worth $4 million one day. I think, today pushing 70 a door in 3 or 4 years, it'll be a, 85 per door property, if not more. So
Not too bad. Who's gonna be the first to find a deal like this week? All right,
Yeah, why not?
let's go.
Well, I'll tell the sad thing after
Don't tell
we do the exciting. So, yeah, there you go. That's why I'm wearing them today, never satisfied. We found negotiated a deal, personally guaranteed the bank loan, executed the value add plan, ongoing asset management, negotiated sales price. We ended up with 75.5% ownership, but we didn't put any money out of pocket. But we're doing all the work. And the investors are sitting back getting a check. They put in the $1.2 million, they're getting 24.5% interest. So what that looked like for the investors, I think there was 11 limited partners came to this deal. They got an 8.5% preferred return while the money's in play. They get paid first. They get their capital back first before the GP gets paid. That's the other caveat. We talked about the GP does all the work. Well, we took acquisition fee and we're taking an asset management fee. We're getting paid, but we're not getting the benefit of the upside until the investors get their money back. So for the 2 year, just looking at a 2 year snapshot, the investors, just say that one investor wrote a check for the $1.2 million, they would get $204,000 in preferred returns. They would earn $490,000 in equity based on that projection on what it's worth in 2 years. So that comes out to 28.9% annualized return, which is pretty good. Most people are happy with it.
Yeah, it must be.
So the sad thing is interest rates went up and we got a little more conservative with our buy box, and the 52 unit literally next door to this property came available. Another broker, another good relationship. We offered $47.5 a door, and we thought we were being, a little more aggressive because this one was $45. And they called and gave us a chance to go up. I think we went up to $48.5, and I think somebody bought it for $49 a door. And that's where, and that buyer, called us within 30 days, wanting to buy this one for $6 million. So you can't get them all, but it's just the lesson learned there is be conservative, but don't be too conservative. Yeah, the numbers make sense.
And that's going to be the wrestle of the week, guys. I'm just going to let you know. I mean, the reality of these deals is you got to get multiple eyes on the property, get multiple, the Bible says, many advisors plan to succeed, right? You got to get many people's thoughts on it. And you're going to have Jack, Larry, Dan. I would lean more towards Dan. Dan's probably going to put you in any deal. I'm just kidding. Dan, I'm just kidding. But I mean, you got to wrestle, right? Especially if you know that area. That's one of your greatest strengths as a newer investor is you're local to that area, or you have somebody on your team that's local to that area, and that the rent should be different on one street as it is to the other street, right? I mean, it's the same way in Columbus, same way probably with a lot of you guys' market is like one street's one way and the next street's a different way.
Yeah.
So you've got to be kind of bullish to an extent.
For sure.
And at this event, we're going to probably give you some pushback. We're going to write it down. You give us some pushback, right? Like do that. And
Yeah. The deal in New Hampshire apartment, Jack killed it. I didn't like it. And the operator, the GP, was his own advocate. So you got to be your own advocate and show where maybe
you might know Steven Totter. Steven.
So Jack's looking at it from strictly return on numbers. He's not looking at it from the operating, what you got to do, to get it to that pro forma stake.
Steven knew his the rent.
I may be looking at it thinking it's an area where I've had challenges, but I don't know the area and may have some things off. So you got to be your own advocate for the deal.
Yeah. All right, let's jump into pulling a list of properties. We're trying to blow through this. All right, so obviously there's that spreadsheet that's also in the overview document that's going to be emailed out to you guys. Go through that 100 ways to do it, but here we go. Run a list using dealfire.ai. You can also use anything else. We also have a subscription to CoStar. We have a subscription to Economy. We have a subscription to everything. PropStream is kind of similar. Obviously, CoStar is going to be your number one, right? It's going to be probably the most accurate. They invest highly into calling. Like we get calls. What happened with that property? Or they have a whole team of just research. We've almost brought one of their guys on our team. Was interviewing for a job, but he was just letting me know, like, it's insane. They have a massive department for research and trying to get accurate comps. So they're definitely the number one in the industry, but below them, I think everybody's pretty much the same. Reality may be a little bit higher level than like PropStream, DealSpire, ListSource, but obviously you're going to pay extra for those. So you all have access to DealFire. So I would just use that unless you just want to go the extra mile and pay extra for CoStar or Reality. Okay, so you're going to run a list in your buy box. You're going to get all the properties in that area. Again, for buy box, it's a little bit different than search parameters, right? Your search parameters, you want to be a little bit broader and your buy box a little bit smaller. Why? Because you may find somebody in a different area that also has a property in your buy box, right? Or a property that's lower in units, but guess what? If they own a 5 unit, they may also own a 15 unit, or they may also know people that own a 30 unit, right? So this is searching and calling sellers directly is just a networking game. It's not, I'm going to find that deal right there. It's probably the deal I'm calling about, right? It's a networking game. All right. So don't expect calling sellers to just be like, you got the deal, you want an offer or not. Like, it's about building relationships. I know people with hundreds of doors that still call a few hours every week, just go call sellers. Why? Because it's networking with a peer, right? It's another apartment owner, and you build those relationships, and that's where you see a snowball effect. So just understand that when you're getting deals from your VA or you're calling specifically to owners, those are just relationships you got to continue to build. And we're going to share examples of how we've leveraged VAs and how they produce results. And so you can understand it from that aspect. But that's the big deal. Okay, so what you're going to do is you're going to use skip tracing software if you're not using dealfire.ai. If you're using ListSource or anything else, you would want to probably use like Lead Sherpa to skip trace those numbers or those properties. Skip trace just simply means you're getting the phone number and email of the and name of the owner. Okay, owner of the LLC. Okay. Then you're going to create your script. We're about to roll it out in just a second. And then you're going to call leads or have your BA call leads. How many have a BA in the room? All right, cool. So BAs work. You work them, but they work. But you can call these as well. So at the end of today, we're probably going to try and wrap up around 3:30. So then you guys can go take an hour or so and just get direct to seller leads. All right. And then out of 50 dials. So here's typical metrics that I would say base your projections off of. 50 dials, you should get at least 2 seller conversations. All right. Out of 20 conversations, you should get at least 5 solid leads to follow up with. Okay. All right. So, and then 30 plus after you actually follow up. Follow up's the name of the game. All right, so that's kind of your key metrics. So we have other ways to do this in the challenge, but obviously we're going to go into other marketing channels next or tomorrow. So we'll talk about some of those. We'll go into as deep as you want to go into all those other channels, whether it's direct mail, whether it's postcards, whether it's texting and email. I mean, we have a company that I can connect you guys with that does cold email, and they can get you a bunch of leads that way as well. Or we can just show you what they do. So you want somebody doing it for you, or you just want to go do it. Cold email or direct mail, you kind of have to budget a little bit more than you would with just calling or VAs. But other people to add to your list. So write this down. We need brokers. We need management companies, attorneys, roofers, contractors, CPAs. Those are all people that are currently talking to a prospective seller. Right? We just want to think who is talking to the guys that we need to be talking to and connect with them. And then we have a script in the 100 ways to find deals. All right. That is going to show you exactly how to connect with those guys and how to talk to them. All right. And I'm going to share some scripts in just a second, but you're basically just saying, who do you know that I need to know? Right? You want to end every conversation with that. Who do you know that I need to know? Right? I'm new to the market. I'm building a brand in the market. I'm building my portfolio in this market. Is there anybody that you could connect me with? Maybe a good attorney, maybe a good CPA or a good whoever that is, right? Or any apartment owners that you know that maybe want to sell or maybe looking to get rid of their property. Okay? So this is all things on ways to get deals. All right? This is about deal flow. So be consistent. Everybody say be consistent.
Yes.
Be consistent. All right? I promise you it pays off. I've seen so many people just do a week or two or maybe even months and they say, yeah, I just kept finding good deals. And then we find out they only submitted 5 offers or they only reached out to 100 people, right? We used to have our former acquisition director said he would call he would make 100 offers to get one deal and he would underwrite 100 deals to make one offer. Which may be a little bit absurd, but I don't think you'll need that much if you follow these principles. But. All right. Building your lead gen machine continued here. Google property management companies and attorneys. Find brokers in your target market or key players. You can use LoopNet and Crexy for this, but typically what we're saying in the script, and I'll share that script with you in just a second, is I'm not necessarily interested in that property. You have any other properties that you're looking to bring on market or bring out. Okay? But that's a good way to connect with brokers. They're all around you. They're active, and you can leverage those brokers that are going to be your highest leverage people right there. So leverage social media. Does your community know you're an investor?
That's focused on
Does your community know that you're an investor?
No.
Say that again. Right? Who in your circle knows? I mean, I'm sure you let people know I'm going to a 4-day event, so a lot of people probably know. But have you shared that on social media? Have you shared anything to let people know that you're looking for properties? If your number one job is to find properties, does anybody know? You know, like we got to get it out there and share on social media. Share, this is what I'm doing. So we have a whole team that can connect with you on actually creating that verbiage, maybe for social media. We're going to talk about that in a little bit, but long-term networking, that's huge. All right, so here's your list. Here's what you need today. Off-market list of sellers for cold calling. You can have your VA doing this step as well. But today, if you have a VA, that you would want to check in on that VA and see how they're going, measure their KPIs off of this. Melvin is our VA manager, so he can connect with you as well. Just message him. But they're doing a great job. I'm meeting with them very regularly, and they're getting a lot of leads every week. We measure how many leads per VA, per VA manager. And NPS scores, it's very important. So 200 leads and dials should equal 8 to 12 conversations, should equal 2 offers, which an offer, we're going to talk about this on the leaderboard in a second, an offer is anything that there's 50% confident in getting that deal, and ideally you're within 60% of the sellers asking. Now I have seen where we've made them an offer for half of what they asked, and it still got through. Who was I just talking to that did that? Chris Caffrey. Anyway, somebody talk to Chris if you want to lowball somebody. All right, effective lowballing. All right, commercial real estate brokers, Masterminds, LoopNet, Crexy, Google. So these are all ways to find those brokers. This is going to be a high leverage way right here, guys. 30 dials for brokers gives you 10 good conversations. Okay, bare minimum. Brokers like to talk. 2 good deals or offers should come from that. Now you say every single one of them, or probably 8 out of 10 is going to present you deals, but out of that, probably 2 good deals. All right, you may actually get a lot of properties, but typically only 1 or 2. All right, because that's their job. And depending on how you run the call, which we're going to talk about, depends on if they tell you the deal that they've had on for 2 years and they just still can't get it across the line, right? Versus, don't waste my time. Tell me if you have any deals that are actually good, right? Power players, property management companies, private lenders, attorneys, etc. 30 leads, same metrics as above. So 200 dials to sellers, 30 dials for brokers, and 30 dials for power players. All right, makes sense? You with me? All right, cool. And then also repeat the above metrics, then if results are under KPI, key performance indicators. We iterate. Understand, these are 2 businesses. One is finding deals, one is raising capital. So we iterate. If we go after running a business and we don't nail it every time, right? It's not going to immediately be the most effective, most optimized machine that you've created as soon as you start. You got to go back and see where in this KPIs, the 200 leads, 8 to 12 conversations, 2 offers, where is my funnel breaking down? Tomorrow we're going to actually go through constraints and break down every part of the funnel. If you're not hitting KPI, if you're not hitting those metrics, if you're not having any conversations, what does that mean? Right? You've made the amount of dials but aren't having good conversations. You aren't making any offers. What does that mean? Right? We have tons of conversations, tons of deals, but we're not making any offers. Why is that? Right? So you've got to approach this as a business, right? It's a funnel, right? We got to make sure we address every part of the funnel to make sure we come up with a predictable system of buying apartments, right? When we hire Dan, we can't just say, all right, go after it. Hope we get a deal, right? We're going to pay you every month, but hope we get a deal, right? No, we pay him and we say, okay, here's the metrics that we need to hit every week, every month. And if you do that, we can ensure and guarantee an ROI for ourselves when we invest in deploy like that. Right? Make sense? Okay. All right, step 3, quick analysis. If I can get Mr. Jack Zhao up here, we're going to do some napkin analysis. Important first goal is to decipher bad deals from good deals. The good ones aren't just laying in the streets. All right. So what's most important for finding good deals is that we decipher the bad deals quickly. Now look, I know a lot of you came in here with a deal, but what's even more important is that you're still sourcing for deals, right? You're still keeping that pipeline strong. And then also look, we're going to be real honest about our perception of the deal. You can give us pushback, right? And some of them we may, we do have an NDA. We're going to have everybody sign that we could probably send out, but
Raise your right hand.
everybody raise your right hand. Nah, it's all good. You don't have to worry about it. All right. We got to get through the bad deals quickly, and we got to not attach emotionally to deals until we have to, right? Until we're in we're at the closing table. Really, I want to say until we're after due diligence and our earnest money has turned hard. But even then, it'd probably be better to back out, lose your earnest money, than it would be to go even further in the hole by doing the deal, right? You want to say, okay, well, do everything you can to make sure you don't get your earnest money and go hard. But even then, it's like, you could lose a lot more than that if you do the wrong deal.
But you shouldn't have to lose earnest money.
Should, yeah.
You have
Our goal here today is to make sure you don't lose earnest money. Cool. So let's jump into a quick analysis. Here's a buying criteria, A, B, sometimes C-class areas. We've already talked about that. But here's how you qualify it. You want to drive it, or you can ask somebody to drive it, right? This is the point of having boots on the ground, partnering up, right? If you're not in that area, you can have somebody go drive it. I mean, you could also just ask a handyman or ask somebody in that area to go look and give you their synopsis. But you can also Google Street View it. That's my favorite. That's the first thing I do. Larry said that's the first thing he does. As soon as he gets a deal, he just goes and looks at it on Google. And it gives you a real-time view of the property. You can drive down the street. You can do all that kind of stuff. So super easy way to do it. And then obviously, if it's in a nice area, if it's in a C plus B area, it should be improving over time, right? If things 5 years ago were kind of run down, or if there's a few areas in there that is run down currently, you should be able to go back a few years and see that it was even worse and that it's actually improving over time, right? So that would give you an idea of like it's a C plus B area, right? Versus D areas probably have looked that way for a long time. Property management companies call and ask if they would manage it. A lot of people are wanting to rent there. What's one of the things you're asking when you're calling property management companies about a property?
Stop calling anymore.
Why not?
Manage the house.
Oh yeah. Well, we're talking about deciding if it's a good deal or not.
Oh, not vetting the management company to manage it for you.
Well, you can act like that. I mean, you can tell the property management, we could give you first bid if we buy the property. But even before that, really, you're just wanting to find out would they even want to manage there.
Yeah.
Right? Because here's the deal. You get a property in a C minus area, one of your biggest issues is the fact that it's going to be hard to find a good property management company. Yeah. So you kind of want to know, that's really the hardest part.
Yeah, just general intelligence, not just property management companies. You're just telling contractors, property management companies in the area, just get the bill for that property, because a lot of people local that have that knowledge will tell you things that obviously the seller and the broker aren't going to tell you, right?
Yeah, actually, I got some experience that we're doing a 40+ million acquisition with the family office. 2 weeks ago, I got a random call from the family office asking about, hey, your Google review looks terrible. It doesn't look like you're managing the property. Your management company is doing a terrible job. What's going on? So the first thing I would look into it is definitely the Google reviews. See how the tenants reviewed this managing company and see their overall Google review. And that's the first thing I would look into it. And the second thing is that I would, in the boots on the ground experience, just go and take a look at the properties to see if the managing company is taking care of the property. Very small things.
Go back at night.
No.
Yeah. There you go. Yeah. All right. Cool.
That's great.
Yeah. Thank you. Yeah. So at your property, or when you call property managers, you really can go 2 routes. It's like one is, you're inquiring about the property, but then you can call the actual property management there at that property and see what their occupancy is. Like, act like a renter. Act like you're going to come in and actually rent the property. Say, hey, if I were to, apply for a 2-bedroom bath, like how many are you have openings there? How many, how long do you expect before, it would be occupied, or do I got plenty of time? All that kind of stuff, right? You're just kind of asking them based on being a renter. And that's the biggest thing around qualifying your, and understanding what the property is like. Is just act like a renter. Go to apartments.com, look for comparables that have similar amenities, all that kind of stuff. And then Family Watchdog, Crime Maps, Area Vibes, Zillow. All those are really good softwares and platforms that you can look at schools, safety, crime. You can look at all those different things. Okay?
Yeah.
Cool.
But you're doing the same thing on not just your property, but other properties to determine what that market rent is to run your initial analysis.
Yeah, exactly. Okay. All right. So napkin analysis. Who feels like they understand napkin really well? Okay. Who doesn't understand napkin analysis really well? All right.
Well, there's some people in between.
Some people didn't raise their hand. Right? Yeah. Who's in between? All right.
Nice, they know, but they don't want to have to go demonstrate it on the floor.
All right. So look, what's needed for your napkin is simply market rents, unit mix. Well, the technically, we can back up here and say it's really just address. If you know how to find the property, you really just need the address. All right. So that's one thing to know. You can find out through online what is needed or what kind of units there are at that property. You can go to apartments.com, look up that address, and it typically tells you. So really, if you have have a hunch that a seller is willing to sell, and or they're not giving you much information, you could technically just go look up the address. But to do the actual offer, we've got to know the market rents, the unit mix, the expense ratio, and the renovations needed, and then obviously the cap rate. Okay. If you can get the T12 and rent roll, that's great. But that would be more for the deeper assessment. What we're trying to do in the napkin is just get a quick synopsis of like, what is this worth my time? That's really, the napkin analysis is just a filter. It's really not supposed to be like this is how much you can offer, all that kind of stuff. This is just, am I even close to this seller's asking? Is it even worth it for me to keep going? Okay.
Yeah, and you're right. You can find just about everything. If I just knew the address, you can go on to apartments.com and pretty much determine most things. The unit mix is really the only thing that you would have a hard time verifying. It's not accurate.
Yeah.
On even CoStar or wherever.
Yeah. Okay. Yeah. Exactly. Napkin analysis, and you're just trying to get a quick synopsis. Okay. All right. So here we go. Here's the calculation. I need you to get your pens and papers out. Get your calculators out. We're going to do this together. Market cap rate. You can, the most accurate source for your market cap rate is going to be your commercial mortgage brokers or your who's doing the assessment? What's the name of it?
Appraiser.
Because they're actually seeing deals sold recently, and that's really what you're getting that market rate or market cap rate based off of. What did the properties in a similar condition sell recently? Okay. Example 1. Here we go. We're going to do this calculation together. Let's say, okay. First off, quick calculation. So it's basically your unit mix times your market rent rates times 12 months. That's your gross potential rents. That's the first number you need. Unit mix times your market rents times 12. That gives you your gross potential rent of the property. All right. Now you take your GPR, your gross potential rents, and you multiply that by your expense ratio.
So GPR multiplied by your expense ratio, that's not NOI.
Yeah, you're technically, because it's 50%. It's what we're going for. So you just assume it's 50%. So you can do 0.5. It'd technically be, you'd subtract your expense ratio, your expenses.
Yeah, it's actually expense ratio and losses off gross potential, but we want to complicate it.
Yeah.
Includes that.
You're assuming the expense ratio is 50%. That's going to vary between 40 and 60, depending on your property. But we'll talk about that. Now, look, if anybody feels confused at any point during this napkin or during this whole training, write the questions down. I promise you, we're going to go over this more times than you want us to go over this. All right, so don't feel like you're getting left behind.
Yeah, don't want to complicate it, but for tax's sake, keep it materially correct. You have gross potential rent. You have rent.
I think I was saying the GPR times the expense ratio, that's the operating expense. The NOI should be your GPR minus your operating expense.
Exactly.
Right. I got you.
Yeah. Let's get through this real quick. NOI divided by your cap rate, just say it's 7%. All right, so that's your market cap rate. I probably need to put that in there because people get confused there. I just said we need the market cap rate. That's not the same as what the broker put on the OM as far as your in-place cap rate, right? What the property returns if you pay cash for it right now, right? That's
Higher up on the mic. Don't hold it at the bottom.
Oh,
There you go.
okay. So that's not the same as, when a broker says you can make 7% on your money, that's not the same, right? This is a market cap rate for, as in what can I sell this property for if it's fixed up, okay? If the property is fixed up in good condition, what can I sell it for? Okay, typically I would say nationally it's probably 6.5, somewhere around there. If you include Class A, it's probably more like 5.5. But just saying in this example, the market cap rate is 7%. So your NOI, your net operating income, is what we got once we took our income, gross potential rents, minus our expenses. That gives us our NOI, our net operating income. That's our profit before debt and for investors. Right? That's our NOI, net operating income. Okay? Then we take that NOI, the net operating income, we divide it by the market cap rate. And that gives us our stabilized value. Okay? All this is about future projections. This isn't about what the property is currently doing. Because as an investor, I just want to know what can I make from this property. And then we can back in what can I offer based off what's going on today. All right? So NOI divided by your cap rate gives you your stabilized value. Stabilized value times 70%. In our buy box example we showed you, as long as it's under 80%. Now, if it's a nicer property, it has very minimal work to do, we may be 85, maybe 90, right? But that's going to be, typically your nicer properties, maybe a longer term play. All right, it's not necessarily the typical model that we're showing you where you could do like we did in that deal, make $2 million in 2 years. That's not the same thing. All right, we'll talk about that in a little bit. All right, so your stabilized value times 70%. That is a discount based on us saying the property's not in the future right now. I can't buy it for its future value. But what is it going to take me to renovate this property and get it to the future value? So I need to bake in a discount, and then that's called your total cost basis. Your total cost basis, and then I gave you another word there, maximum cost basis is another word for that. Maximum cost basis minus your reno cost equals your maximum allowable offer. So the big things you need is market rent, unit mix, expense ratio, or just assume 50%, market cap rate, and an estimate of your renovation. And again, you could just estimate, if it's a light to mediate value add, you could just estimate $5K a door, $3K a door, right, for renovation. Again, you'll go deeper in this after the napkin analysis. All right.
No. Yeah, I think we can just give it like a real world example real quick too. get back the rents, and we could show you.
Yeah,
Because it's not a lot of theory. You just do it, we can do it in your head almost.
Yeah, that's going to be the whole thing this week. All right, now get analysis. So do this on your calculators. We got a 2-bedroom, 1 bath. 2-bedroom is $1,000 market rent. 1 bedroom is $800 market rent. Okay. And then, I like.
Is it all? Pretty sure it's all.
We make the slide a little bigger.
That's what I was wondering.
Visual.
I don't
Maybe it's
think
hard to
so.
see.
All right, so unit mix, let's call it 50 units for 52 bedroom units, 71 bedroom units.
Just stop us if you can't see something. We'll clarify.
You're doing it on the board here.
Don't look at it. Just do it by yourself. Don't look at it. Do it by yourself.
Yeah, don't give me the answers.
Think
You
about
gotta get, all right. Expense ratio, just say 50%. Renovations needed. Let's just call it 1.2 million. So this is a total of 120 unit deal. And the asking price is 6.2 million. Here's our formula. Unit mix times your market rent rate times 12 equals your gross potential rents. Who's got that number? There it is. Who got that? 1.2? All right, so all it is your 2 bedrooms, 1,000 times 50 units. 800 is your 1 bedroom times 70 units. You bring those together, you add those together, and then you multiply that by 12 months, gives you your gross potential rents. 1.272 million. All right. Now, who's got the NOI? GPR times your expense ratio equals NOI, or minus your expenses, but in this case, we can just do 0.5.
It still works.
No, it still works because it's
Challenge
0.5.
Jack's brilliant brain there. It still works to multiply the kind of expense ratio. If you take in gross rents, you got a 60%. That's fresh.
What expense ratio are we expecting?
Yeah.
Yeah, if it's 60% expenses, then your NOI would technically be 40%. Right?
Right. Yeah, you're
Successful.
multiplying it right now. Yeah. Or
So it'd be, but either way, we're at 50%. Just quick napkin. All right.
that makes it work on it, but
Yeah. Yeah. Easy. Cool. Who's got it?
636.
Boom! Got it. Who got it first? Dustin? Okay.
I'm calculating
Big shot.
I'm calculating 60% expense ratio, but anyway,
Jack wants a better deal.
I want to be more conservative, so using 60.
Yeah, I want to walk through that at the end to talk about how expenses have changed.
We'll talk about it.
Everybody understands.
All right, renovations needed. We got 1 point, or no, we're here. NOI divided by cap rate. Divided by 0.07 equals your stabilized value. Where are we at?
9.8.
You got it. 9.085. If you're not with me, we'll talk about it in a little bit.
Look on your neighbor's paper.
Look on your. All right. Stabilized value times 70 to 80%. In this case, we're going to go with 80%. So your stabilized value, then we want to back out a discount. We only want to pay 70 to 80% of what it's worth in the future, and then we're going to minus our reno cost. But for right now, what is the total cost? Who's got it?
7.
Boom! You guys are on top of it. Let's go. All right.
Question. I see. Go ahead.
Ranges.
Yeah. So stabilized value, like I was saying, basically if it's 70% or even lower, it's typically based on the fact that it's got a lot more work to be done. It's a lot more risk. Because what we're doing is taking the stabilized value, what it's going to be worth if it's fully occupied or if it's fully at market rents, if it's in the future, you know. And then what we want to do is say, well, it's not there and it's going to take some work to get there. And so this is where you get competitive about, you know, what are you willing to take? And so we'll break this down on the deal analyzer where it actually shows you your cash flow month, you know, what you're actually going to produce year one as far as cash flow, as far as your investor returns. So all this will get more clear and you'll be able to make the decision as far as how much of a discount do I need whenever you look at the deal analyzer, okay? Because you just got to say, is it worth my time to do this deal? This is where it gets for us. Like if we do a 20 unit deal, we got to be careful that we're not spending time getting an extra $10,000 in cash flow a month or whatever that is, right?
Doing that analysis, so like the more renovation needs, the lower. So
That's right.
charge something less.
Yes.
Yeah, you just want to know what plug in, right? So it's your discount. So what if it's a nicer property that you like, you know, nice area, you're gonna be a bit more aggressive than 80. But it's C class, you know, it's got a little more hair on it, then lower. Or just do 75 every time and make it easy.
Yeah, again, the idea of the NAC is just a quick assessment, right? We can break it down further later. But if you just know like, hey, this property may need a little bit of improvements. It's not going to need like, it's not under 70% occupied, you know, stuff like that. It's not a super old property. If it's in the 60-year-old property, you know, you got to think about, you may need a 65, 70%. But for the most part, as long as you're staying within our buy box and what we're kind of teaching you, it should be around 70 to 80. You can call it 75. All right. For this one, stabilized value, total cost is 7.26. And then total cost minus the reno. What do you got?
66.
You got it. All right. Now, here's the rule of thumb. Go ahead.
So how do you determine that renovation?
So yeah, renovation amount. We'll get into that in a little bit. Yeah, just write that question down. We'll make sure to cover that. But again, right now we're just thinking, how do I make my NAV analysis process like 60 seconds? You know, 90 seconds at the most. All right, because we got to get rid of bad deals. So the question is, do we keep moving from this deal? The asking was 6.2. We found out 6,068,000 is what we can offer. Now the rule of thumb for me is if I want to spend my time going to the next level and doing more assessment on this deal, I need to probably be within just say 30% of the seller's asking, right? So 6 million is what of 6.2? 97. So we are well in the range to keep going, right? So as long as it's over 70%, I'm typically keep going. Make sense? I say 30% as in a margin there between this other, but it's actually over 70%.
Yeah. And if you want to get more at bats, you know, when you're learning this, do 80 here every time to be a little more aggressive. And then if you're 50% of what they're asking, have a conversation with them anyway, tell them and follow up.
Exactly. Yeah, no, we'll talk about that. If you're 50%, you can still give a courtesy call to the broker, give a courtesy call to the seller and say, hey, our underwriting team came back. We're not anywhere near. You know, I don't want to waste your time. Just, you know, let me know if you have any other deals. So, all right. All right. Biggest mistake in analyzing properties quickly to hit your targets. Very important. Problem number one, you're looking on market or you're looking at stabilized properties. All right. Solution. And why is that a problem? Because typically if they're on market, they've already been passed by thousands of investors and there's something going on with it, right? And it's just, again, we're maximizing our time with people with little time, busy, newer investors. Where is our time best spent? All right. And we could say we could look on market all day, but that is probably not going to be your hottest leads. All right. And you can look, you can say for the sake of, you know, just getting something in, you can go to a property that's been listed for more than 100 days or something like that. See if they want to come down. Right. That's fine. But it's not going to be a bulk of your time. It's not going to be that much of your time. So main thing is we want to be more prospecting. Stabilized properties typically have lower in-place cap rates, higher occupancy, minimal to no capital expenditure needed, or no pain. Reason, motivation to sell, example, bad management. That's why it's not really that exciting, right? You're gonna have no pain, right? They're just like, why are they wanting to sell? And then your timeline is a lot longer. Problem number 2, assuming too high of a market rent. Finding accurate market comps is the solution. Okay, so like I said, go to apartments.com, act like a renter. Find accurate market comps. Jack, you have anything on finding accurate market comps?
Yeah, first of all, the broker or seller will give you some market comps, but it doesn't mean these market comps are correct or they're honest. So the best way to do it, I would go to there's a the best way to do is definitely to request something called a CoStar, which is a third-party vendor report. The brokers usually can provide it, but some small shops they won't be able to provide a CoStar report. So what you can do is to go to a website. It's called apartments.com. Anybody here have used apartments.com before? You feel it's good, useful? So good. You like it? So go to apartments.com, find that subject property, and then click on the map. Then you can find some comparable properties right next to the subject property, and then you click into each comparable properties to make sure they're at the same vintage, they're built around the same time, the same quality, and sometimes also check their management companies. Some management companies are terrible. Check the reviews. If you find their reviews are similar, their quality similar, everything looks similar, and that must be a good comp. And one thing it's worth mentioning is that you might find some properties with very low rents in that area. That might be because that's a light tech property, which is low income tax credit property. They have some rent restrictions. So if you're doing a market rate property, to make sure to confirm that the cost reviews are for market rate as well. That's my experience.
Did you just say the low income, what was that?
It's called a light tech, low income tax credit property, essentially
Low income housing.
low income housing, whatever. So essentially the housing light tech, whatever, that one have more experience that because he bought a property.
Yeah, I got it. I'm an expert.
Yeah.
Got more.
So the fund usually give them the money for the development, but in return, the developer has to have to lower the rents or restrict the rents at a certain level to make sure it's affordable for low income people, right? So if you are buying a market rate property and then you're looking at the rents for these low income tax credit properties, then you're not comparing apples to apples to make sure that you're also looking at market rate properties as your comp. So that's how I find the comparable properties.
Find out if they haven't looked. Yeah, like. Yeah.
Yeah, let me present it as that. Sure. Nobody told you it was. It'd be pretty bad. You just kind of to the underwriting. And it's until like title work.
Section A is different.
You can have Section 8 in your properties, but some people get confused. There's properties that have contracts that are restricted as well, have a certain percentage rented only to Section 8 tenants.
Yeah, we'll get into that. So finding accurate market comps, same class neighborhood, Google Maps, drive the area, age of the property, similar amenities. Know the market to get faster. So this is the whole crux of the issue with navigate analysis. If it's taking you 10, 15 minutes, makes sense if you don't really know the area. You're having to research all this from scratch. But we can pump out 3 offers in 30 minutes because we know the area. Like we know that market cap rate, we know the market rents, like we know what's going on. So the more you know your market, the faster you can get at deciphering the bad deals, getting the better deals. All right, so research your market. And again, this is going to come with reps. It's one thing to get. If the more you do it, the faster you're going to get. Okay. Problem number 3 is assuming too low of a market cap rate. All right. So you want to get better comps. Check sold comps. 75, 25. Typically 25 being properties on the market for less than 6 months. So you could go on looking at look at sold comps. You could go on everything like that. Anything else, Jack, around biggest mistakes analyzing properties quick for investors? Biggest mistakes analyzing properties for new investors.
Honestly, the rents are definitely that most important thing. You have to figure out that you're looking at the right properties, the right comps to find out, the rents for
Don't
property
take
that
the
you're
broker's
gonna visit.
word for it.
Don't take the broker's word for it.
And also
Yeah.
property tax as well. That's very brutal. A lot of times assessors will just reassess the property value to the taxable value of the property to very close 95% of the purchase price. So for example, in Florida, if the property hasn't transacted since 1980s, they have a cap on the taxable value increase. So their taxable value on the assessor's website could be much lower than their market value, but when the property transacts, they will bring the taxable value all the way up to the market value of the property. So sometimes you will see a double or triple of property tax after transaction to some of the markets. So these are things that you should always look into before making that decision.
It's good. So, calling sellers. We got 30 minutes and I got a lot to cover. Okay. Calling sellers. We're going to be talking about keys to success in calling. Then I'm going to roll out a new script that we just put together. Get to the point quickly. Hey, this is Jonathan, owner of, hey, is this, sorry, I'm reversing this. Hey, is this name, if you don't have the name, LLC name, is this, Golden Gate Capital, whatever, or,
Bro.
Huh?
Bro.
bro, hey, bro, no, don't do that. Hey, is this, name of the owner, with the property at blank address, blank street. Because you open it up that way, it could be anybody, right? It could be your neighbor telling your apartment's on fire, it could be anybody. So kind of want to just open up that. Hey, this is Jonathan, South Court Capital Group. I wanted to see if you would be open to getting an offer on your property. All right, be confident yet engaging and down to earth. And we're going to show you plenty of examples how to do this. But say something funny, relatable, or lighthearted to break any tension. We'll give you guys a list of jokes by Larry. Larry's got a list of jokes for you guys. Build rapport over everything else. Many of these connections will result in deals in the future. I cannot over explain how important this is. These relationships are going to pay off long term. What the people you meet in this room this week, it may not be transaction in the next 30, 60 days, but I promise you, if you steward the relationships you make in this room and the people you talk to on the phones, you're going to see dividends for years to come. All right?
Yep.
You have something on?
Okay.
Okay. Make them remember you. Do something wild and crazy. I'm just kidding. Make them remember your goal is to provide value. So value is how they remember you, right? If you actually providing value, you care. It's a very rare thing that people actually care, right? You actually care about them, about the property, about,
Here's your best Southern accent.
use your best Southern accent. Be consistent and follow up. Tell them you'd like to keep in touch and add them to your pipeline and track conversations. So you can track conversations in DealFire, CRM, or just a spreadsheet. I know there's a lot of big companies that still use a spreadsheet. And if you're like me, I love spreadsheets. So just make sure you track it, log what the conversation was about, and then you have a date to follow up. Okay? Dial fast. Don't let fear drive in action. Just keep dialing. This is the biggest thing. Whenever you go out and you try and knock out a ton of dials, you just got to keep dialing. Don't, have the numbers lined up, and then as soon as one's hung up, you're dialing another one. All right?
Yeah. Who hasn't or doesn't like calling strangers?
You don't like
one honest guy. So who likes calling strangers? Who likes getting cussed out? All right. Henry had a great story as a broker. He had a really good story on our Thursday call last week that I thought was really good for being persistent.
Yeah, so being persistent, very important. Like we talked about following up. So one quick story, there was an owner I wanted to get in contact with. And he owned a lot of property in the area and I just couldn't get him on the phone. So I kept calling and calling, he's on your list, and I called and I finally get it to answer. He answers the phone, I'm like, this is it, this is my shot. Don't blow it. As soon as I go to say something, how effing dare you call me at this hour? It's like 7:30. I'm having dinner with my effing family and you're calling me? Who the F are you? And I'm like, oh my goodness. I'm like, oh, I blew it. So I'm like, all right, cool, hung up. And then sure enough, 2 weeks later, guess who comes up on my list again? I'm like, oh man. Do I give him a call? Press call, give him a call. I'm like, here we go again. What happens? As soon as I'm like, hey, it's Henry. We spoke last week during dinner. And he said, I am so sorry. You were like the fourth person that called me that day. And I was just fed up trying to have dinner. My phone keeps going off. I am so sorry. And then it turned out to be a wonderful conversation. I ended up getting the meeting, going to his office, and that could have easily been a call that I didn't make. Right? Easily a call I didn't make.
I keep talking. Yeah, that's so good that you called him back. Most people don't do that.
Send thank you notes, follow up emails, keep in touch, guys. We're going to drive the point home. Conquering fear. I'm going to run through this really quickly. Limiting belief. I don't have any credibility or provide any value on the calls. Now, again, we're going to do partnerships. Some of you are like, I'm going to outsource this talking to people thing. I'm going to find a partner in the room who's willing to do it. Totally fine. It's up to you, right? But for those who want to level up in this area, this is really important, okay? I think every single one of you have the ability to do it. Right? I don't have credibility or provide any value on the calls. Empowering thoughts. You are calling them to help them solve a major problem, all right? They want to sell their property or know that one day they have the option to sell their property. You have a team of investors who can help, right? We're partners. This is a team sport. You can use the word we, you can use the word partners, this is, we're behind you, all right? So just be empowered to understand that. Also, you're gonna take care of their property, give them personal assurance that you care, right? So you are providing value because you can take care of their property. You also have local market knowledge. And the reality is fear comes from ignorance, confidence from knowledge, right? Fear comes from ignorance or incompetence. Right? Competence equals confidence. Okay. And then you're also making them an offer on their property, right? So that's value in and of itself. Like you're going to give them a real market valuation, right? It's based on your assumption. All right. Take action, even if small steps. The best way to overcome fear is to face it head on. Okay. Take action, even if it's small steps at first. Each step will build your confidence. Visualize success. You see yourself as a successful real estate investor. You're no longer, after today, you're no longer aspiring real estate investors. You are real estate investors. All right? That is who you are. All right? So understand that you are successful. You will have a major portfolio very soon, regardless of the person you are talking to. It doesn't matter who's on the other end of that phone. Right? And then every no, Mark Cuban said, every no gets me closer to a yes. It's a numbers game. You have to get no's in order to get a yes. Right? So how bullish are we? Talking to sellers and brokers. Try your best to speak directly to the seller or the broker that is speaking directly to the seller. So if you're talking to a broker, we don't want to be going broker, several brokers in between the seller. We want to be able to talk directly to the seller, at least through that broker.
Even one like that wholesaler shirt.
No wholesaler shirt. So simply do your best to hear what they want. You got to actually listen to what do they want. That's going to be your key, right? Don't overthink or overtalk. Just make the connection and get the needed metrics and say, I'll reach back out after talking to my partners. Okay, can we give you a call later today so I can have my partners on the phone as well to get you the best offer? So it can be later this week. So this is one thing that you guys are going to be able to do is just set appointments for us. If you want to just watch us talk to the broker, talk to the seller, and you just want to see how we do that, while you're getting up leads, talking to brokers and sellers, just say, look, can I have, let me talk over with my partners. Can we give you a call later today? I can have my partners in the room and talk to you then. Okay? Proof of funds. I'm going to share a little bit of script on that. But reality is just as much as they want to know you are serious, you need to know if they are serious. All right? So we're going to talk about that in just a second. Credibility add. My partners have been buying apartments around the Southeast and are looking to expand into other markets and add another 1,000 units this year. All right? Just to give yourself more credibility. It's just something you can add. All you need is the T12 and rent roll. Look at the deal analyzer. So we're going to talk about that in a second. And so when you're talking to sellers and brokers, that's what you want. understand not everyone's going to be nice. It's a numbers game, like Larry said. If you're over being cussed out, you'll do well. I'm just kidding. I don't, you know.
That's what VAs are for.
That's what VAs are for. Follow up on both leads and offers. All right, so here's the broker script. Let's zoom out. All right, so this is the document that we're sending you guys. It's an updated overview of the resources for today. But it goes through our buy box, pulling leads, napkin analysis, and then here's the new broker script we just created. And the cold calling script is still the same. This is how you cold call. Same for VAs and how you could do it. So you just made that your own. But broker script, let's jump into it. All right, this is much simpler. Hi, broker name. This is your name. I'm part of a multifamily acquisition group, actively buying apartments in the blank market. I wanted to introduce myself and see if you are seeing any opportunities. See what opportunities you're seeing coming up right now. Obviously, I just put it together, so or I should proofread it. I'll update this. Real time. We're working together.
All right, well, while you're pausing, I said, oh, great. How many deals have you bought?
Yeah, we're going to go through that in just a second.
Nice. Play.
All right, there we go. What opportunities you're seeing coming up right now? We focus primarily on value add or light reposition opportunities and can move pretty quick if the numbers make sense. Okay. If you saw the current listing online, hi, this is Jonathan. I'm an investor in the area. I saw your listing on LoopNet. Do you have any other multifamily deals in the pipeline? Okay. Stop talking. Let the broker respond. Now we're just going to assume they've got objections. We love objections. But again, ideally they just say, yeah, we got several different things going on, or may say, who are you working with, all that kind of stuff. But we're going to talk about that. So proof of funds, we'll need proof of funds before moving forward. Totally understand. Just so you know, we're trying to vet the deal just as much as you're vetting us. We work with syndications, so capital gets lined up once we confirm the deal fundamentals. If you can show the T12 and current rent roll, I can quickly confirm whether this is something we'd actually pursue. I don't want to waste your time or ours. Make sense? Okay. And then you stop talking. Broker pushes. Well, we just want to make sure you can close. That makes sense, and that's fair. The best way to make sure we don't waste any time is to confirm the deal actually works first. Once we're aligned on pricing and structure, proof of funds isn't an issue. Okay? Seller requires proof of funds up front. Got it. How about we meet in the middle? If you can send me over the T12 rent roll and CapEx history, I'll take a serious look and let you know quickly whether we're moving toward an LOI. At that point, if we're aligned, we can address next steps. If it's a good deal, we can figure something out. Like, you know, you need a screenshot of a bank account, you know.
Yeah.
Well, I mean, then how many people are like, I got $5 million in my bank account, I'm ready to close right now. You know, they're not expecting that. They just think that you're not able to close.
Created a mini of my own proof of funds letters over the years. Sent to Bank of America. Okay, they just check a box. No different deal with brother. Don't commit fraud.
All right. Why don't you already have a proof of funds? Because we don't raise capital blindly. We make sure the deal fundamentals work before we pull investor capital into the process. That's how we avoid retrades and fallout later, right? Flip the script. We've had buyers waste our time before. I get that, and that's exactly what we're trying to avoid. All I need to determine is seriousness is a T12, or to determine seriousness is a T12 and rent roll. If it pencils, we move forward quickly. If not, we'll tell you right away. All right. Who are your investors? That's a good one.
Yeah.
Hold on a second. We work with a group of capital partners depending on the opportunity. Once the deal checks out, we align the capital for it.
Like
Bottom line.
Actually, a wise guy to say, I'll see this now. What you
Yeah.
nice guys.
Yeah, there you go. Yeah. Send me your email. I'll send you a list. I mean, and then reality is like, okay, let's move on to the next question. All I want to know is this deal worth it? Is it worth me spending my time? I don't want to be getting someone proof of funds or even anything if the deal doesn't make sense. So bottom line is never argue about proof of funds, just reframe it as a deal vetting issue. And like, as long as you're confident and it was like, this is This is what I mean. Like, I'm not trying to waste my time, nor are you trying to waste your time. So, like, just tell me what's going on. Or if not, hey, see you later. Like, next call. Right. All right, cool. So I think we handled that. Did you have something?
Just real quick, you've spent a lot of time on objection handling. That's great. Why would they be so opposite or resistant to pull it to themselves in a red roll? I mean, how long does that actually take? A lot of effort?
Because they're protecting their seller and they sense that you're not a experienced seasoned buyer. They want the guy that just closed 100 units last year and now he's closing 100 units. So that's the reason for the investment. But you can sum all this up. I'll just say real quick. I mean, it just boils down to being quick on your feet, confident, and you don't have anything to hide. We talked about that a lot. But so by the time we leave this event, I think you can make your own script. You got to put it in your own words what you're comfortable with. You try to say all those things, try to word for word, you're going to sound even more fake. So, but if that gives you a good structure, that's a very good structure of things that come up. You've saved it. I think we're going to either call live brokers and sellers at this event or we'll role play so you can, take your notes and leave here with what works for you. And that's the reason they're doing that. Like quickly. Oh, I mean, deals will be closed. Just since you're another one of these people who watched a YouTube video that's calling them wasting their time and not serious. That's really all that level. You're serious. You're going to buy apartments. You got pieces in place to do.
There's nothing coming out.
Is that kind of answer?
It's not.
Is it acceptable to say, sorry,
They're the guard. They're the gatekeeper. The guardian. The seller. The direct sellers aren't going to usually hit you with that. They'll play along with you, but they're gauging that. You can bet in the conversation. This guy wasting my time or not.
is it acceptable to
What do
say
you-
the
what do
group
you
that I
do?
work?
How do you answer it when they do say have to be?
Let him go ahead if you don't mind. He was in mid question there.
Is it acceptable to say the group that I work with, REI, has 500 million under management?
Yeah.
I mean, to get the broker to
Yeah, for sure.
forward. That's it.
Yeah, I'm hesitant to tell people to throw out too many numbers and too many names dropping because then they sense that as other, I would just be confident like we've got, I work with a group, we've got capital ready to go. I'm the point guy to get the deal. See if it's a viable deal. We're ready to close one.
Oh, that's great.
We want to close it. I was thinking about my own script when I college people. Usually I'm just making small talk, but probably come out of the gate with, we put together a lot of capital. We need to buy a deal this month. We can't buy but one. Is yours going to be the fit?
There you go.
So a little bit of scarcity and capital, typical kind of stuff. What was that question?
Yeah, he got it.
Okay.
Yeah, that's good. Now I would probably say REI Capital or REI just puts it out. I mean, REI Accelerator. That's massive. Still could be fine, but I would just probably say REI.
Just to give an indication to, you're working with a group that has the experience.
Yeah.
Yeah, but it's also never pushed that back too.
Exactly.
You don't want to. You don't give them all your cards either. Say who you're working with. We have some investors with a lot of money. Oh, who are they? Well, why would I give you their name? I would give you their name. Well, who's your investor? Give me your best investor. I'll give you my best.
Seriously, this might sound funny, but it's really how you got to think about it.
Yeah, because you're confident. Then they go, "Oh, this guy's serious.
Well,
He must drive a Mercedes."
yeah, but I think what we usually do is tell them to say, hey, I have a group of high net worth investors, which I have invested in for, $5, $6, $10 million during the last 35 years. That's the narrative you can use. Or family members. That's what you should do.
Yeah, it's your own voice, right? Everybody.
All right, follow-up script. Last point here. You want to send this, so we're going to have time to do this. Talking to people today, 24, 48 hours, you're following up. Thanks again for taking the time. As mentioned, we're actively reviewing value-add multifamily opportunities in blank market and plan to be acquisitive this year. Please keep in mind, so I'll replace that. Please keep in mind as opportunities come up, happy to take a look and give quick feedback. All right, so here's the needed information. Write this down. This is the needed information for brokers today. What kind of potential do you see? First one. What kind of potential do you see? This is what we're initially asking brokers when they present as a deal or sellers. What kind of potential do you see? All right. Why are you / they interested in selling? Like I said, if it's been on the market, and your first question is like, why is it not sold yet? Right? But this is assuming it's off market.
And you can even say it. I'll say it too. I'm sure you've already put this in front of your best buyers. You know, why did any of them pull the trigger?
Yeah.
Make them talk. Ask them questions. You're not calling them to big questions.
Yeah. What elements are most important to you / the seller? So part about the sell. Is it like just retiring? Is it avoiding capital gains? You know, what is it most important to you about the sale? Someone taking care of your property? You know, what is that they're most interested in selling? 'Cause some of these mom and pop sellers that's had the property passed down through generations, and so they want to know that you're going to take care of the property, right? So that be surprised. Network for more names. Who do you know that I need to know? Who do you know that I need to know? Put a star next to that question. We're trying to build our pipeline. So who are the best property managers, worst property managers? Any recommended lenders? Any power players I could expect? Don't call them power players. But inspectors, attorneys, real estate, trust, litigation, divorce, estate, etc. Network for important names. Build your network. That's probably a good exercise for you today, is to look at your current network. Who do you need in your network? Where's the parts of your business that you feel weakest at? List those out and just ask for those people. You know, hopefully you find some of them here today, but maybe there's other ones that you need. Or there's CPAs or whatever that is. All right, submit LOI. So we're almost done. So LOI, obviously this is going to be primarily, today is about getting on the phone with sellers, getting the leads, doing the napkin analysis, getting confident in what kind of offer you can make. And then tomorrow is going to be more about LOI, about letters of intent. But hey, if we run through your deal and you feel confident, by all means, go ahead and do it. But I would say for the most part, for most of you, if we're just starting out, we're just getting these leads going, we just want to get leads in the pipeline, make calls, and then assess them on napkin analysis. That's the win for today. Tomorrow we can start pumping out those LOIs. All right. So just a quick summary on LOIs. It's letter of intent. It's basically a handshake. All right. It's a non-legally binding document declaring the preliminary commitment of one party of your business with another party. Outlines the chief terms of a prospective deal. It's not legal. Okay. Once you get that accepted, it's typically, you got about a week, 2 weeks, maybe 5 days minimum to get that property under contract. All right. And so we've got a LOI template for you guys. All right, so here's a quick deal. Just want to give you another idea example. If you have equity for the down payment, or if you have the equity for the down payment, which can be through limited partners, or if you have a 1031 exchange or anything like that, you can do this model. But it's basically, Brandon was a key example. Construction background, family, 2 kids, no experience on larger deals, brought in partners. We're going to be talking a lot about partnership. 27 units. $750,000 for 27 units, all in cost. Closed 3 months ago. Bank 75% lifetime value. 75% loan to value, 7% interest. Down payment was $210,000. He did a cash out refinance, 8% interest, 2-year term. And he used a partner to give the loan.
He did a cash out on other properties.
Yeah, exactly. Yeah, for that down payment. Here's another example. Larry, you want to run through this?
Yeah.
This is
Really good.
power of direct to seller.
Yeah, PA found this guy. Actually, it was 3 guys that owned like 75 units, and originally they agreed to sell the entire 75 units to us. Then they changed their mind. They all agreed, call them with partners. So kept following up with this guy. He was the most engaging because he really wanted to sell. So they ended up splitting the portfolio and got all that done. After 12 months, he ended up with a few houses and this 16 unit. And they all agree on all of them pretty clear. They just built this over a 10, 20-year period. They all still had jobs. They were managing the property. The guy's cell phone number was in front of the property. When the toilet didn't work, he's the one that got called and actually went and worked on it. So he was motivated to be done with property management, or he wanted this property management to do maintenance too. He was everything. So we offered him, walk through. Our offer would be less than 800, what he was wanting for the property. I don't know what it was. Maybe it was 650, maybe it was 700. And we kept, inching up higher as he was able to provide maybe better terms. So we ended up at 800,000, and then after some due diligence, we went from, I think, 80% financing to 90, and then eventually to 95. So it was just all negotiating and realizing that he really wanted rid of this property, and all he wanted, he didn't want cash. He didn't need a bunch of cash. And he was also aware of him having to pay taxes on all that cash. And when you do installment sale or seller financing, they only pay capital gains taxes on the money that they receive. So there's an advantage to the seller. So we were able to get it with only $40,000 down, which is 5%. And really cash flowed out of the gate, but he was also well below market rents. I think he had people in there at 500-600. Now we're getting 800-900 for it. You have to renovate those units. You also have people who've been living in there for 15-20 years with very outdated units and dirty units. So that's what a lot of these mom and pops do. They don't want to go up on the rent because they don't want people to move, because he's going to have more work to do because he's the maintenance guy. So it's like they're fine with those people standing there 15-20 years, but they're afraid to go up on their rent. So you got lower value property. So I don't know what it's worth today, maybe 1.2-ish or something. But that wasn't the point. I'm in it for the long haul, and you can overpay for a property when they're giving you fixed financing. I think he may have pushed back on the 15-year because he's an older guy, but we ended up, I know that these 10-year, but the amortization is like based on a 20-year, so the cash flow is really good, and we've got fixed like I don't remember what it was.
4.25.
Like 4.25% interest rate, which was lower than market interest rates at the time too. So but the key, I think, Chuck wanted to point out, is just the follow-up of this guy. And then a year after this, one of the partners that saw the light came back and sold us his properties. Unfortunately, they were just a bunch of dirty duplexes, but we still bought because they were in our backyard. And he did finance it as well.
Not too bad. Direct to seller, follow up. Those are the two key terms there.